Good afternoon, Farm and Ranch Management. Welcome to your first video lecture. We're only going to have one or two of these per week. So in my mind, it's important that we understand that we're not trying to just simply replicate what I would do in class online. Hopefully I'd dress a little bit better and comb my hair a little bit better. Instead, we're going to try to deliver the same content and the same learning outcomes in a different manner. And some of what that means is that some of the responsibility is more on you. The learning will become more active instead of passive. We won't have opportunities for you to sit and for me to say, here's what we're going to do you understand this, calling on people and so on. Instead, it's, hey, make sure you read, and then hopefully I have some insight as to what should be confusing for you, things that I might recognize that you would struggle with, and then in a short 15 to 25-ish minute lecture, you can unpack some of those things and then move on to the assignments and to the quizzes that are actually worth points. And I know a good grade is something you probably desire, so these will definitely help you out. So this video, I have 4 main points that I want to make. And you might notice that I have just flatly skipped chapter 1 and chapter 2. And that's because I feel that all of you can handle chapter 1 and chapter 2 pretty much by yourself. The book is well written. Read them, you should be fine. Chapter 3, little different story. Most of you haven't had accounting before, so we have to have a basis for understanding the type of accounting that the book assumes that farmers and ranchers are going to adopt. So number 1, we're going to define and understand what accrual accounting is, and we'll compare that with cash accounting. Number 2, we're going to learn the accounting equation and how that relates to something called a balance sheet. Third, we're going to talk about revenues, expenses, and profit. And we will see how that relates to the income statement, or what is oftentimes referred to as a profit and loss or P&L statement. And finally, we'll talk about cash reconciliation and a cash position. Note, though, we're not going to be talking about very specific details, really just a general overview of each one of these things. So let's move on to number 1, accrual versus cash accounting. So we think about accounting as bookkeeping to some extent, and I think that most accountants, and rightly so, would be offended if you said that accounting was simply bookkeeping. Bookkeeping is recording transactions. Accounting is about using a framework to help us make business decisions and management decisions with the goal of maximizing profit. That's something that economists, and I am an economist at my core, really believe that all firms should be maximizing profit. Now, within the bounds of their own mission and their beliefs, Chick-fil-A is an example, they're probably not maximizing profit by being open on Sunday. But within their Monday through Saturday mission and way that they operate, they're trying to maximize profit. So we're going to adopt accrual accounting as a way to keep track of our business and our operations so that we can maximize profit. And we're going to compare that with cash accounting based on the rules of each one. So the rules of cash accounting are quite simple. If a cash event happens, some accounting transaction is recorded. And the account that is always affected is cash. If you make a purchase for cash, it's recorded. If you sell something for cash, it's recorded. But if you sell something and extend credit to your buyer, cash accounting doesn't identify that something has happened. If you buy something on account and will pay later, cash accounting doesn't identify that something has happened. So cash accounting has a benefit in that it's very easy to implement. Cash happens, we write it down. But it has a shortfall. It doesn't understand other economic events whereby cash is not exchanged. And that's what accrual accounting is about. And the rule of accrual accounting is, if an economic event happens, an entry is made. So and the book has a great example, and we're gonna walk through that here when we get down to revenues, expenses, and profits, that shows the shortfall of cash accounting. Now, I'm not saying that utilizing cash accounting is wrong, because the one advantage that it has is you always know your cash position. But the big disadvantage that it has is we don't always know what's happening to profit and loss. And that's going to be one of our overarching goals if you're operating or managing a business. So cash accounting, very simple. If cash exchanges hands, an entry is made. Accrual accounting, the rule is still just one rule, but it's far less simple. If an economic event happens, there shall be some sort of entry. Okay, so I'm going to check off number 1 and clear some space for myself. The accounting equation would probably be a day 1 thing that you would learn in an accounting class. And it states that assets equal liabilities plus owner's equity. Now, this is not all of the account categories that we have. We're missing revenues and expenses and some subcategories. Instead, the accounting equation looks at things that we own, assets that have value, debts, things that we owe, liabilities, and then owner's equity. And if you're thinking about this from a standpoint of if this is new, which it's really hard to think in depth about something that's new, this equality might not make sense. So instead, I just do a little bit of algebra, I think, to make the accounting equation a little bit easier to understand. Now, my algebra teacher told me that, Tim, if you have an equation, you can do anything to one side of the equation if you do it to the other side of the equation. So if I subtract liabilities from the right side of the equation, they're gone, but I have to subtract them from the left side of the equation as well. So I'm left with assets minus liabilities equal owner's equity. Now I've got something that makes sense. Assets, I have a $10 million farm. It's worth $10 million. Minus the $5 million mortgage loan that I have means that I have owner's equity of $5 million. Owner's equity is the liquidated value that's yours. Liquidating means turning something to cash. If we sold all of the assets and paid off all of the debt, what would be left over that would be yours? That's owner's equity. From a personal finance standpoint, owner's equity is oftentimes called net worth. What is the net worth of the business is the same thing as discussing how much is owner's equity. So it's not that these two things added together equal assets. It's really about what's left over is my change in owner's equity. So if my liabilities are staying the same, but the farm is appreciating in value, my owner's equity goes up. The opposite can happen as well. If farm values go down, land prices stay the same, but our equipment gets old and depreciates economically, it's not worth as much on the market anymore, but our liabilities stay the same, our owner's equity goes down. Owner's equity in that way mathematically is the plug. It's the offset that allows the equation to always be in balance. Okay? So the accounting equation is the simplistic form of the balance sheet that we'll look at in, I believe it's chapter 4 or 5. The balance sheet is simply looking at assets and liabilities, and it's breaking them down into different types of assets and liabilities. I'll give you an example. A current asset is something that is cash or will be used as cash. Cash is a good one. If we have grain in inventory, we're going to sell it. That will become cash. It's an asset. But a tractor is an asset too. A building is an asset, land is an asset. Those are things that are long-term assets. We own them, but we don't own them for the purpose of selling them. They're still assets. And we can categorize those on the balance sheet. The balance sheet does the same thing with liabilities. And we can start looking at the intricacies of our asset and liability position and how that changes from one year to the next and how operations or the market has changed those things. So in truth, if someone says, what is the accounting equation? It's assets equal liabilities plus owner's equity. If we subtract liabilities from both sides, I think it makes a little bit more sense. I have my assets, I pay off my debts, this is what's left over. I'm in my house right now. I think the house, we don't know what the house is worth unless we sold it. But last year when we found out that our dependent load was changing from 2 to 4, we looked at buying a bigger house and went through the process of, do we want to sell this small house? And it was worth $220,000. So let's say that the market value of the house has stayed the same at $220,000, and I owe $120,000. My asset is $220,000. My liability is $120,000. My owner's equity in the house is $100,000. Is that because I've paid $100,000? No. In the 4 years that I've lived here, I've probably paid $30,000 or $40,000. But the home has gone up in value quite a bit, and that has allowed me to increase equity in the home. It works for your personal situation, it works for businesses, it works for farms. The accounting equation holds true. Okay, hopefully we can check off number 2 and clear off a little more room. Revenue, expenses, and profit. And this is where we can start to understand the intricacies of accrual accounting. So we know that profit in accounting is equal to revenue minus expenses. It is just that economists just use the Greek symbol pi for profit. Remember, geometry doesn't own pi, it's just a Greek symbol, it's a letter. That revenue, we know what revenue is. We produce stuff. Sometimes it makes noise until we kill it and cut it up and sell it. Sometimes it grows from the ground. Sometimes we milk it. We're producing products and selling them and creating revenue. But to get that product ready for sale, we incurred some costs or expenses. If I take the revenue minus the expenses, I'm left with the profit that we added or that we get to keep. This becomes an issue when we have a production period that doesn't match up with the fiscal period. So we have a calendar year, we have a fiscal year, and we have a production cycle. And it just so happens that the production cycle of grain crops in Nebraska match up pretty well with the calendar year, but that doesn't always mean that this is going to pan out. So if we look at chapter 3 and you turn to page 50, if you're in the red book, I don't know where it is in the green book, it says a cash versus accrual example. It's the same example in the green book, if that's what you have. And the basic premise of this problem is that you grow crops in this year, and let's just say that the year is 2020. You've got crops in the field right now, they're very young, but by October and November they'll be ready for harvest. You harvest those crops. All of the expenses for those crops happened in 2020, but we only sell half of what we harvest. Corn is the example in the book, it stores well. How do we figure out what our profit was if we're putting corn in storage and not selling it? I want to make decisions in 2021 about what to plant and what to produce and how to produce it, but I have to look back at 2020 and say, how profitable was 2020? If I haven't sold half of my crop, I have no way of knowing what profit there was. So we have two accounting principles that help us understand how to pin down profit and make good informed decisions. The first principle is called the revenue recognition principle. And I'm going to give you my version of the definition of these principles. You can look them up online. They're probably a little wordier and more complex than mine are. The revenue recognition principle just states that you record the revenue when it's ready for sale. When the product is clearly defined by the market, it has a value, it's done, that's when you can recognize it. So in our textbook example, when the farmer harvests corn and then goes and sells half of it, you shall recognize all of it. You sold 100,000 bushels at $4 a bushel, you put 100,000 bushels in storage, recognize all of the revenue. You can think about inventory as what I'm really doing is buying the product for myself. And that works for two reasons. Number one, it just flatly helps you understand, how do I recognize revenue if only half of the cash is coming in? What about the other half? Well, just think about yourself as the customer and you purchase the other half, which works really well in the corn business, in the livestock business. If you're selling half and you're planning on feeding the other half to an animal, in which case you would have had to have bought that anyway, and the revenue can be recognized. So recognize revenue when it's ready for sale and has a specific market value. Go through that example in the text. Number two, our second principle is called the matching principle. And the matching principle goes like this: match expenses with the revenues they create. So there's not an example for this in the textbook, but let's say that it's the end of the year, it's December, and you're sitting on a big pile of profit. What do a lot of farmers do? Try to buy down that profit. They don't want to pay income taxes. I don't want to pay income taxes either. So they say, well, we have a whole bunch of profit this year, and my taxes are based on a cash system, so I'm going to buy a whole bunch of next year's inputs this year to make it look like I didn't make that much money. And that's fine. But I want you to be able to understand how much was the profit from this year. That's what accrual accounting is about. So if you buy inputs in 2020 that are going to be used for 2021, we have to figure out a way to match those expenses with the revenue they're going to produce, which is going to happen next year. And the way that we do that is we show those items as prepaid expenses. A prepaid expense is simply an asset that you plan on using later on, and we'll recognize it as an expense then. Okay. So for example, if you buy seed for next year, you buy $10,000 worth of seed. Well, certainly cash goes away, but you replace that $10,000 worth of seed with an asset called prepaid seed. You've purchased something ahead of time. It is an asset that's shown on the books, it's on the balance sheet, but it's not shown as an expense until next year when we actually use the seed. So number one, the revenue recognition principle and the matching principle allow us to take, and think about this. I have in this example, 2019, 2020, and 2021. And in 2019, I can do things like buy prepaid expenses, and I can store grain. And in 2020, I produce and incur more expenses, sell some grain, store some more. In 2021, I can sell stored grain. So what I'm really trying to do is I'm trying to figure out what happened in 2021? I have to figure out, how do I move these expenses into this year and make sure that these sales don't go towards my 2021 profit, that I'm understanding them in 2020. That's what accrual accounting is about, and it's really not that complicated. You should take financial accounting if you get a chance, and you should take managerial accounting if you get a chance. I am going to paint broad strokes of accounting to help you out. Okay? Number 4, cash reconciliation and our cash position. It's kind of a paradox. A business can have positive cash flow but not be making a profit, or a business can be making a profit but not have positive cash flow. Cash will reconcile over a long period of time, whereby a cash position and profit are the same. But in the short run, we have to come up with an accounting strategy to recognize our cash position. And that strategy is simply to have something called a statement of cash flows that looks at our cash for the previous year. So the statement of cash flow looks at sources and uses of cash. So sources are cash in, uses are cash out. It's looking at our sources and uses of cash and splitting it into operating, financing, and investing activities. And it's saying, how does cash work in your business? If you have problems, here's what may have happened. That's what we do looking backward. Looking forward, we have a cash flow budget that we will look at much later on in this course. So really the point of number 4 is saying, just because accrual accounting isn't so beholden to cash that it really doesn't care about cash in the same way that cash accounting does, doesn't mean that we've forgotten about it. Because having positive cash flow and the ability to pay bills and to operate is awfully darn important. That's something to never lose sight of, even as we're struggling through, or maybe just sailing through, these accrual accounting examples. Okay, one final note on accounting before we go any further. I want to talk about expenses and liabilities. Okay? An expense is a cost that happens because we're producing. That's an expense. A liability is a debt that we owe. They are not the same thing. Sometimes we pay for an expense with a liability. I purchase fuel on account. I have an expense, fuel expense. I've created a liability because I didn't pay for it with cash. But sometimes we have bills that are not liabilities. Insurance is not a liability. In fact, it is almost never a liability. It is insanely important that you understand that bills are not just liabilities. If you owe a debt, a bill is a liability. But when the insurance company sends you your insurance bill, you're paying forward. You don't owe the insurance company any money. They're just saying, hey, if you want to keep your insurance coverage going forward, you need to pay now. Insurance is never a liability. In that case, you're buying an expense ahead of time. You're buying 6 months worth of insurance coverage up front. It's a prepaid expense. It's an asset. And I know that's the fact because I've traded cars before in the middle of that 6 months. And what does the insurance company do? They cut you a check. You paid $300 worth of car insurance, you don't have a car anymore. And you only used a third of it. They'll send you $200. Okay? So let's make sure that we understand, again, that expenses and liabilities are not the same thing. Liabilities are debts. Period. End of story. Full stop. That's it. expenses are costs that happen because we're producing. So let's not get those confused. Okay, I'll see you folks here later this afternoon, and I'll point that this is off in YouTube space, and hopefully you enjoy it. Thanks.